Right now, a single invisible financial mistake is quietly draining the net worth of 24-year-olds and 68-year-olds equally. It happens because we all chase the arrival signal. Without anyone explicitly telling you, society conditioned you to buy specific things to look successful, rather than building the assets that actually make you successful. My name is Shreyak, and you're watching Shreyak Finance, where we break down how money actually works, not the Instagram version, the real one. If you want to build real wealth instead of just looking rich, make sure you subscribe. Now let's get into it. By the end of this video, we are going to audit your last 30 days of spending. You will calculate your exact monthly leak and map out exactly how to reallocate that money. Recognizing these culturally programmed signals is step one. Breaking their spell is the mandatory baseline for building genuine generational wealth. Let's find out which trap you're caught in. Step one is diagnosis. If we look at the post-war era, many families rented their entire lives. Owning a home became the ultimate, indisputable symbol of the American dream. For the boomer generation, this created a specific trap. Take someone like Robert. At 68, his net worth looks huge on paper, but practically all of it is sitting inside the four walls he lives in, leaving his actual retirement savings critically underfunded. Then came Generation X. They entered the workforce during the rise of the dual-income household. The cultural pressure here was to visibly out-earn their parents. This created the trap of lifestyle creep. Every time someone like Karen got a promotion or a raise, her life immediately expanded to match it. She bought upgraded cars, moved to a bigger house, and took overseas holidays. Take a look at this chart tracking income versus expenses. While her gross income shot up over 20 years, her lifestyle expenses climbed right alongside it. Her actual savings rate remained entirely stagnant. Neither of these generations were financially reckless. They were careful, budgeting people who simply followed the unwritten rules of their eras. They achieved the visible appearance of arrival and assumed that meant financial security. Millennials faced a different economic reality. The crashes of the late 2000s wiped out early career foundations, making assets like property feel completely out of reach. When you can't afford a house, you spend on what you can. For someone like Marcus, that meant substituting real equity with experiences, weekend trips, and brunch culture to simulate a wealthy life. An entire cultural machine validated this behavior. They were told that memories were the ultimate currency, which left an entire cohort with fully stamped passports but zero hard equity. Today, 19-year-olds discuss index funds and compound interest as casually as social media trends. This high level of exposure makes Generation Z the most financially literate cohort in history, yet they face the most aggressive, visible trap ever created. Someone like Zoe knows the math, but she still spends hundreds of dollars a month maintaining an expensive aesthetic online. She performs wealth to an audience, while her actual investment contributions remain tiny by comparison. Whether the costume is a suburban house, an overseas trip, or a ring light aesthetic, the core mechanism is identical. Every generation prioritizes the look of money over the math of money. Now that we've defined the trap, it's time to measure your own. Pull up your last 30 days of bank statements. Look at every transaction and identify which purchases were primarily made for social signaling. You have to separate utility from signal. A car gets you to work, that's utility. The extra $400 a month you pay for the luxury badge, that is signal. Plug those numbers into this equation. Monthly signal spending minus monthly asset investing equals your signal gap. If you spent $800 maintaining your lifestyle, but invested only $100, you have a $700 signal gap. That $700 is the literal monthly tax you are paying purely to wear a costume of wealth, actively robbing your future self in the process. To fix this, we have to cut the psychological feed. Digital algorithms are explicitly engineered to reward the performance of wealth and induce constant lifestyle envy. Open your feed right now and unfollow 3 accounts that trigger status anxiety. Replace them with creators focused on financial substance and actual asset growth. Next, apply the assets first reallocation rule. If you are dealing with lifestyle creep, automatically bank 50% of your next raise. If you're caught in the experience trap, trade 3 small weekend trips for automated monthly index fund transfers. The ultimate rule is this: you are only allowed to upgrade your lifestyle once your compounding assets are generating enough yield to genuinely pay for the upgrade. Escaping the trap requires a conscious choice. You must be willing to temporarily look much less wealthy than you actually are so that your real wealth can grow faster. Recognizing a massive signal gap in your own finances is the moment the illusion finally breaks. You've stopped following unwritten rules and started looking at the actual math. By shifting those exact funds from the signal column into the substance column, you stop playing society's game and start playing your own. Accountability starts by naming the problem. Go down to the comments and tell me exactly which generational trap you've been stuck in. Hit subscribe for more wealth-building audits like this one, because when you finally arrive at real financial independence, you won't need to announce it to anyone. If this video helped you see money differently, subscribe to Shreyak Finance, because here, we don't just talk about money, we help you build it. And remember, real wealth is quiet. You don't need to show it, you need to grow it.